Hi, I'm Vishwa. In this video, we're going to talk about a simple trick that can increase your probability of success when you're trading intraday breakouts. Let's get started. Breakouts are simple to identify and trade. It doesn't require a lot of complex analysis or calculation. And that's why many day traders prefer trading breakouts. Because in intraday, you have to be fast in placing your trades. If not, the trade is gone. You just missed it. And one advantage of using breakouts in intraday is that you will have enough time to find and mark the key price levels of the stock. The levels from where we can expect a strong momentum. Now, marking these levels are easy, but trading with it is not. Because not all breakouts will be successful, and more often the breakouts fail. So, is there a way to use this simple method more efficiently? Yes, and that's what we will focus on in this video. Watch the video fully and don't miss any key points that we will be discussing here. Pretty much anyone can identify these breakout patterns. So we won't be talking about the details of how to find these patterns. Instead, we will brush up lightly on the logic behind breakouts. So what are breakouts? Well, very simply, breakouts are the spots where the price starts to trade out of a certain price range, right? Okay. We even refer to this as consolidation. And there are various types of consolidation as well. If you notice here, in all these consolidations, the stock price is restricted to a narrow range. And these narrow ranges don't always mean the same thing. Because if you think about it, consolidation can happen in two different circumstances. One is when the price is losing its momentum due to decreased trading activity. And this happens when there is no enough liquidity in the stock. And two is when the price is building up strength for its next trending move. This happens with an increased buying or selling interest. We even call it accumulation or distribution. So, how to identify the difference between these two? Because ideally, you want to trade the consolidation where the traders are actively buying or selling, right? So that you will have a higher chance of success on your trade. To do this, we can look at the market activity. If you think about it, trading activity in the market will not be equal throughout the day. Instead, there are times when the trading activity will be high, and there are times when the trading activity will be low as well. For instance, you will see a lot of trading activity during the morning, right after the market opens, and in the evening before the market closes. And you will normally see much less trading activity during the middle part or at the noon session of the market. So ideally, you will have to look for breakout trades near the morning session or when the market is nearing its close. Now, just by doing this, you can automatically filter the breakouts that have a higher probability of success. Now, let's have a look at some intraday charts. And to keep things simple, we can define a timeline for the breakouts. For the morning session, it's better to see a breakout before 11 a.m. And for the evening session, it's better to look for breakouts after 2 p.m. Now, at these times, normally you can expect the market to be more active. And in this case, we do have a consolidation breakout before 11 a.m. Now, that's also a rule, and the breakout did work in our favor. Now, in this example, we see a consolidation even before 10 o'clock, when the market would be really active. And this is a good sign because it means that there are a lot of new positions coming in, but the price is still trading in a range. And this means that the stock is preparing for the next strong move. And once the price broke out of this range, there was the strong down move. In our next example, we're going to see an exception to this rule. Because in here, if you see, the breakout occurs only after 12 o'clock. Now, in this case, we can take it as a valid breakout because of one simple logic. If you look at this chart, the price is consolidating right from the very opening of the market. It didn't trend anywhere. Rather, it just traded in a range the whole time. So, what this tells us is that right from the morning, the stock was just accumulating strength for a breakout. And as you can see, when the price finally broke out of this range, there was a strong momentum to the upside. And in this last and final example, we see a breakout near the end of the market. Here, we see a breakout after 2 o'clock. Now, this is normally the time when the trading activity would begin to increase once again. So, when you see a breakout after 2 o'clock, like you see here, it would normally be accompanied by a higher trading activity. And this adds a greater advantage to your trades. Now, by doing this, using time as a filter for your intraday trades, you can avoid trading most of the fake breakouts. And in this way, without using any complex analysis, you can actually increase your probability of success when you're trading intraday breakouts. So, if you enjoyed watching this video, give us a thumbs up. And if you find the contents of this video useful, you can share it with your friends and fellow traders who can make use of this as well. Like our videos, then subscribe to our Candletricks YouTube channel, and don't forget to click on the bell icon to turn on the notifications so that you won't miss anything important from us. Thanks for watching the video. Have a great day. Thank you.